In Part 2 of Chapter 20, we will be talking about how to do cost, volume, profit analysis. This is a useful technique that firms can use to determine how changes in their cost or their level of activity will affect their profitability. In order to use this technique, we need to understand contribution margin. Total contribution margin is the difference between total sales and total variable costs. In other words, each unit that's sold has to be able to cover its own variable costs. Whatever is left over is the contribution margin from that unit. So the total contribution margin is all of the contribution margins that are contributed by all of the units that are sold. As the activity level increases, total sales and total variable costs are going to increase in proportion to the change. So that means, for example, if we sell twice as many units, we're going to have twice as much sales revenue, and we're also going to have twice as much variable costs, which means that we will also have twice as much contribution margin, the amount left over after each unit contributes part of its sales revenue to cover its own variable costs. So we can say that contribution margin goes up in proportion to an increase in the activity level. Unit contribution margin is the difference between the sales revenue per unit and the variable cost per unit. That is, how much each unit contributes to firm profitability after it has covered its own variable cost. Therefore, contribution margin per unit is going to stay the same as long as the selling price per unit doesn't change and the variable cost per unit doesn't change. When we do cost, volume, profit analysis, we need to make some simplifying assumptions so that our math is easy and the lines on the graph are nice and straight. Those assumptions include the fact that we assume the price doesn't change as the volume changes. In other words, we don't worry about any price reductions for big orders. We also assume that we can separate all costs into either variable costs, fixed costs, or mixed costs. In addition, we assume that the only reason that our variable and mixed costs change is because of changes in the activity level. In other words, the prices don't go up on a per unit basis and they don't go down. In addition, we assume that fixed costs are not going to change due to a change in volume. In other words, we're ignoring the possibility of a rent increase. And finally, we assume that our inventory level is not going to change. In other words, we make exactly the number of units that we expect to sell. In Chapter 21, we will relax that assumption and see how changes in inventory affect our understanding of firm operations. To do cost, volume, profit analysis, we need a basic formula. That formula is fixed costs plus any target profits divided by the contribution margin per unit will give us the number of units that we need to sell in order to achieve that goal. Let's see why this formula works. Contribution margin per unit, we already said, is sales revenue per unit minus variable costs per unit. In other words, it's telling us how many pennies of sales revenue are available to the firm once the variable costs of that unit have been covered. So we are dividing the amount of contribution margin from each unit into all of the fixed costs that have to be covered and all of the profits that we want to make, and that's going to tell us how many units we need to sell in order to achieve that goal. Let's look at an example. ACME Widgets sells its product for 60 cents per unit. Each unit has 36 cents of variable costs. The firm has $1,500 of fixed costs each month, and currently they sell 12,000 units per month. Let's say that we want to know how many units must be sold in order for the firm to break even. Remember, break even is the point at which the firm can cover all of its variable and fixed costs, but with nothing left over. So the operating income is zero. Revenues exactly equal total costs. No firm wants to operate at break even, but all firms want to know where break even is so that they can determine whether they're in danger of not breaking even. So we start out with our basic formula, and if we want to figure out where break even is for ACME Widgets, we fill in all the numbers that we know. The first thing we have to do is determine the contribution margin for the firm. We know the contribution margin per unit equals sales revenue per unit minus variable cost per unit. For this firm, sales revenue per unit is 60 cents. The variable cost per unit is 36 cents. That gives us 24 cents of contribution margin for each unit. In other words, each unit contributes 24 cents either to cover fixed costs or for firm profits after it has covered its own variable costs. So in our formula, the contribution margin per unit is 24 cents. The fixed cost is $1,500. And because we're trying to find out how many units the firm has to sell to break even, the profit is zero. When we crank out the math, we find that the firm needs to sell 6,250 units in order to break even. Luckily, we can check that answer to see if it's right. Will the firm break even if it sells 6,250 units? To find total sales revenue, we multiply the selling price, 60 cents per unit, times 6,250 units. Total variable cost will be the 36-cent variable cost per unit times 6,250 units. The difference gives us our total contribution margin. That margin has to cover the firm's fixed costs before the firm could possibly consider making any profit. The fixed cost for this firm is exactly $1,500, leaving us with a profit of 0. And that's the definition of break even. Now, supposing that ACME doesn't just want to break even, they want to earn a profit. In this case, they want to earn $1,800 of profit. So we start with our basic formula. Contribution margin hasn't changed. It's still 60 cents of sales revenue minus 36 cents of variable costs for each unit gives us 24 cents of contribution margin per unit. Now we need to add all of our information to our basic formula. This formula says that we need to sell enough units, each contributing 24 cents of contribution margin, to cover $1,500 of fixed costs and give us $1,800 of profit. When we crank out the math, we find that the firm needs to sell 13,750 units in order to be able to cover all of its fixed costs and leave the firm with $1,800 of target profit. This is very bad news for the firm because they're currently selling 12,000 units per month. In other words, if their sales stay the same, they're not going to achieve their target profit. That's a managerial issue. Now the firm can think about ways to increase its sales so that it can achieve its goals. But is this number correct? We can check it out. At 60 cents per unit of sales revenue, we can figure out how much total sales revenue the firm would earn. We notice that the total sales revenue increased compared to break even because we sold more units. We can also figure out how much variable cost the firm will incur by taking the variable cost per unit, 36 cents, and multiplying it by the total number of units. And we notice that the total variable cost has also increased compared to break even because we're at a higher activity level. The total sales revenue minus the total variable costs gives us the total contribution margin. In other words, if we sell this number of units and each unit covers its own variable cost and contributes something to the firm, we will end up with $3,300 of contribution margin. And we notice that total contribution margin has increased compared to break even because the activity level has increased. We've sold more units. But we don't get to keep all of this contribution margin. Some of it has to cover fixed costs. The fixed costs don't change, even though we're at a higher activity level, because one of our basic assumptions is that the fixed costs are fixed within the relevant range. This leaves us with a target profit of $1,800. That means if we sell 13,750 units, we will achieve our profit goal. Now it's manager's job to figure out how to make that happen. This graph summarizes everything that we just said about ACME widgets. Like the graphs that we've looked at before, the x-axis represents the activity level expressed in units, and the y-axis represents dollars, either dollars of revenue or dollars of cost. The white line indicates sales revenue, and you'll notice that that line goes through the origin. In other words, we don't have any sales revenue if we don't sell any units. The slope of the line is the sales revenue per unit, 60 cents, and the line increases as the number of units that we sell increases. The dashed white line indicates total costs. Those costs are mixed. Some components are fixed and some components are variable. The fixed component determines how high up on the y-axis the line starts. This firm has $1,500 of fixed cost. So that means that even if the firm doesn't sell any units, at least in the short run, it will still have those costs. The slope of the line is the variable cost per unit. In other words, in addition to the fixed component of the firm's costs, each unit is going to cost the firm 36 cents of variable cost to produce. The place where the revenue line and the total cost line intersect is break even. That's the point on the graph where sales revenue exactly equals total costs. If we go down from break even to the x-axis, that will tell us how many units the firm has to sell in order to break even. If we go across from break even to the y-axis, that will tell us how many dollars of sales revenue the firm has to generate in order to cover all of its costs at break even. Any point above break even represents profit. And the farther the sales revenue line is above the total cost line, the bigger the profit is. The area below break even represents loss, and the farther the total cost line is above the sales revenue line, the bigger the loss is. Here are some questions to think about. On the cost volume profit graph, the total revenue line intersects the y-axis where? At the origin, the level of fixed costs, or the break-even point? Right. If you take a look at the graph, the revenue line goes through the origin because when we don't sell any units, we don't have any revenue. The slope of the total revenue line represents what? The variable cost per unit, the sales revenue per unit, or the contribution margin per unit? As the graph shows, the slope of the revenue line is the sales revenue per unit. On the graph, the total cost line intersects the y-axis where? At the origin, at the level of fixed costs, or at the break-even point? Right. The total cost line hits the y-axis at the fixed cost level. In other words, the higher the fixed costs, the higher up that line starts. That means that the more fixed costs a firm has, the more it's going to cost them if they operate at very low levels. What about the slope of the total cost line? Does that represent the variable cost per unit, the fixed cost per unit, or the contribution margin per unit? That's correct. The slope of the total cost line is the variable cost per unit. Where does the total revenue line intersect the total cost line? At the origin, at the level of fixed costs, or at the break-even point? Exactly. The total revenue line intersects the total cost line where those two values are the same. That would be at the break-even point. This is the end of part 2 of this chapter.